already, everyone. This is Matt Langle with Denver Private Wealth Management, coming to you with our Q2 2021 5-minute market commentary. This is going to build off of our previous commentary for Q1 of 2021 surrounding inflation. Now, this video will analyze a little bit what actually happened in Q2, and what maybe we can expect going forward. So, to begin, I want to quickly just remind us of a little bit about what CPI is and inflation in general. Now, this chart does a really good job of starting to understand, when it comes to CPI, we're looking at roughly about 2% is what the Fed puts out is healthy inflation. So, less than 1%, we're looking more at deflationary trends, which is a problem in their own way. Above 3%, it's above average inflationary trends. You're starting to get closer to that sort of that quote unquote runaway inflationary period that maybe you've heard about before. So the blue line, this light blue line, you'll notice in 2020 was the highest time that there was a projection of below 1% inflation over the next 5 years. And that makes sense. Think about what's going on, right? Where the pandemic had just started, shelter in place is occurring. Everyone's thinking that there's no way that the economy is going to be able to grow and expand. And so that's why you see this implied probability here. Now, the dark blue line is going to be the opposite. So what this is really telling us is that consensus has never been at a higher point over the last 10 plus years, that we're going to see at least above average inflation in the next 5 years. So as the pandemic comes to an end, and we're starting to get back, and recover from an economic standpoint, people's concern is that we're going to see that quote unquote runaway inflation, as the economy almost starts running too hot based on that pent-up demand and everything that's happened in the past, especially with these low interest rates, low interest rate environment, and a lot of liquidity in the system. So, building off that, and where some of this inflationary expectation is going to be surrounding the idea of the Fed having interest rates at zero, right? These slashes that we saw to the Fed funds rate occurred back during the pandemic in order to try to spur the economy, and it worked. We've seen that spurring the economy, and initially the Fed said that they weren't interested in looking at increasing interest rates at all until 2024. Yes, there was going to be some inflation above their 2% trend target, but they saw that as not as big of a deal, and the bigger issue being making sure that all jobs got back online. But that being said, in January, we started to see Jerome Powell, Chairman Powell of the Federal Reserve, start to hint at that they're going to have more of a watchful eye on inflation than maybe previously expected. So while the first rate hikes weren't supposed to happen until 2024, he mentioned that maybe there might be some rate hikes as early as 2023 now. And what this chart speaks to is, while Chairman Powell is saying now it's 2023, the market's starting to think that it actually might happen as early as 2022. And with that comes the concern that there's going to be a choking of the growth of the economy, that's going to cause a slowdown faster and more vicious than maybe what the stock market, the economy is ready to deal with. And so people are worried that Chairman Powell and the Fed are going to sort of turn the lights on to the party and kick everyone out, kick the party off, too early and earlier than expected, which is going to cause its own issues. And this chart's really going to speak to that. So this chart's going to look at the implied fair value of the 10-year Treasury yield. And the Treasury yield is usually supposed to be roughly mimic what's going on in inflation. So if inflation is 2%, you'd expect to see a yield of about 2%. And it's also supposed to track roughly what the GDP is of the economy. And what's interesting is while, people would think, and the Fed has spoken to the target more towards 1.8% yield on the 10-year Treasury. As the time of this recording, we're actually closer to about 1.3% percent yield on the 10-year Treasury. And with those decreasing yields, what that's really saying is that there's been a flight to safety, and all this money pushing into the Treasury market has pushed down the yields, because if there's all this supply and all this demand coming in, and all this capital coming into the Treasury market, well, then Treasuries don't need to have a higher yield and be as attractive, right? Because if they're the belle of the ball already, why would they have to stretch and give a higher yield to investors? And what that usually means is that investors are worried about what's going to happen in the stock market going forward, and aren't confident in the future growth of the stock market, of the economy. And we would look at this as a overreaction that's occurred, and that people think the Fed's going to sort of shut the party off too early, and so there's been a big flight to safety into treasuries. And once again, this is 3 standard deviations away would be the quote unquote implied fair value of where yield should be right now. And so at Denver Private Wealth Management, we would think that this is going to be an overreaction that should correct itself over time. But it's something worth watching out for. How the Fed interacts, during their quarterly meetings, and and how they dot plot out where they see rate hikes occurring is going to have a really big impact on what happens in the economy. So I hope this was helpful. Please feel free to reach out about how this may affect your individual portfolio. Obviously, at Denver Private Wealth Management, we're always here for our clients to answer any questions you may have. Thank you.